a comprehensive bull case analysis for First Majestic Silver. The global silver market is currently navigating a period of unprecedented structural transformation, characterized by persistent supply-demand imbalances, the reclassification of silver as a strategic industrial mineral, and the emergence of a new pricing regime. Within this volatile yet highly favorable environment, First Majestic Silver has positioned itself as the preeminent primary silver producer through a series of transformational corporate actions, most notably the acquisition of Gatos Silver and the implementation of a high-margin operational pivot. The Macroeconomic Catalyst, silver as a strategic asset.
The foundational pillar of the bull case for First Majestic is the chronic and widening deficit in the global silver market. As of 2025, the market has entered its fifth consecutive year of structural deficit, with cumulative shortfalls between 2021 and 2025 reaching approximately 820 million ounces. This shortfall is roughly equivalent to a full year of global mine production, illustrating a market that is fundamentally incapable of responding to surging demand through traditional supply channels. Unlike the speculative silver rallies of 1980 or 2011, the current price environment is underpinned by the physical necessity of the metal in the modern power grid and green energy infrastructure. Silver's utility has fundamentally shifted. While historically half of the silver produced was consumed by industrial sectors, that figure has risen to approximately 58% to 59% as of 2025. The driving forces behind this demand are inelastic and tied to global decarbonization mandates, solar photovoltaics, electric vehicles, and the rapid expansion of artificial intelligence data centers. In 2024, solar manufacturers consumed over 25% of the total annual global silver supply, and projections suggest that by 2027, the solar sector alone will require more than 20% of current annual production.
The designation of silver as a critical mineral by the U.S. Geological Survey in November 2025 and China's subsequent ban on silver exports in January 2026 have effectively securitized the silver supply chain. For First Majestic, as a primary producer deriving approximately 58% of its revenue from silver, these macro trends create a powerful tailwind for valuation re-rating as the market begins to prioritize profit per ounce over simple volume. The Gatos Catalyst. On January 16, 2025, First Majestic completed the $970 million acquisition of Gatos Silver Inc., securing a 70% interest in the Cerro Los Gatos mine in Chihuahua, Mexico. This transaction represents a watershed moment for the company, providing a high-quality, long-life cornerstone asset that immediately enhanced the company's silver production by 84% year-over-year. Cerro Los Gatos is a low-cost underground operation with significant byproduct credits in zinc and lead, which has structurally lowered First Majestic's consolidated cash costs and all-in sustaining costs, AISC.
The integration of Los Gatos has been seamless, with the asset contributing approximately 1.5 million ounces of attributable silver production per quarter throughout 2025. By the fourth quarter of 2025, Los Gatos accounted for nearly 27% of the company's total silver equivalent production, providing the operational stability and cash flow necessary to fund ambitious exploration programs across the rest of the portfolio. Strategic plans for Los Gatos include increasing mill throughput from 3,500 to 4,000 tons per day by late 2026. This expansion is expected to be internally funded, minimizing dilution risk while maximizing the asset's economies of scale. Furthermore, exploration at Los Gatos has already yielded a 59% year-over-year increase in inferred silver equivalent mineral resources, with current drilling focusing on the southeast, central, and northwest deep targets to extend the mine life beyond initial projections.
The margin over volume pivot. Following the record-breaking production levels of 2025, where First Majestic produced 15.4 million ounces of silver and 31.1 million silver equivalent ounces, management has signaled a sophisticated pivot for 2026. This strategy, defined as margin over volume, reflects a deliberate tactical choice to prioritize profitability and reserve preservation over raw production targets. In the current high-price environment, where silver has established a new technical floor near $70–$75 per ounce after peaking at over $121 in early 2026, First Majestic has proactively lowered its cutoff grades. By mining lower-grade ore that is now highly profitable at spot prices, the company is effectively extending the life of its mineral reserves and ensuring the long-term sustainability of its operations. This approach allows the company to capitalize on super margins, often exceeding $50 to $60 per ounce, while reducing the operational footprint and environmental impact per dollar of revenue generated.
This strategic reorientation is particularly attractive to institutional investors, who have historically criticized the mining sector for pursuing growth at any cost. By demonstrating fiscal maturity and linking shareholder returns directly to revenue, First Majestic is positioning itself as a defensive powerhouse in a volatile market. The Mexican core: San Dimas, Santa Elena, and La Encantada. First Majestic's three wholly owned Mexican mines, San Dimas, Santa Elena, and La Encantada, form the backbone of its primary silver production. Each asset has seen significant exploration success and operational upgrades in 2025, reinforcing their status as long-term cash flow generators. San Dimas, the high-grade cornerstone. San Dimas continues to be one of Mexico's most important silver and gold mines, characterized by over 120 epithermal veins and a sophisticated mining infrastructure. In 2025, San Dimas exceeded guidance, producing 5.4 million ounces of silver and 56,000 ounces of gold. The operation benefits from exceptionally high silver recoveries of approximately 94% and gold recoveries of 96%.
The 2026 exploration program at San Dimas is the most ambitious in the company's portfolio, with 117,000 meters of drilling planned to test high-grade targets such as the Coronado, Navidad, and Winter veins. Recent drilling at the Elia and Santa Teresa veins has returned impressive intercepts, including 8.38 grams per TAU and 763 grams per TAG over 3.88 meters, highlighting the potential for significant reserve conversion and mine life extension in past producing areas. Santa Elena, exploration-driven transformation. Santa Elena has undergone a remarkable transformation from a depleting asset to an exploration powerhouse. The discovery of the Navidad and Santo Niño vein systems has radically altered the mine's production profile. In 2025, Santa Elena's inferred mineral resources more than doubled, increasing by 105% year over year. The Santo Niño discovery alone added 27.4 million silver equivalent ounces in inferred resources. Total inferred resources for Navidad and Santo Niño now stand at 90.7 million AGEQ ounces, averaging 81 grams per TAG and 1.96 grams per TAU. To accommodate this new ore, the company is expanding the Santa Elena mill from 3,200 to 3,500 TPD by the second half of 2026. This expansion, combined with improved recovery rates, is expected to maintain Santa Elena's position as a low-cost producer for the foreseeable future. La Encantada, operational stability and new targets. La Encantada, a large-tonnage pure silver mine, saw a strong performance in late 2025, with Q4 production increasing 32% year-over-year to 1 million ounces of silver. The company is currently testing a new exploration target, La Esquina, and investigating the potential extension of the Ojuelos resources to ensure consistent production levels.
Jerritt Canyon, the high-option gold restart. While silver remains the primary focus, First Majestic's 100% ownership of the Jerritt Canyon gold mine in Nevada provides a compelling source of non-dilutive growth. Placed on care and maintenance in March 2023, the asset has undergone a rigorous reevaluation that has resulted in a massive increase in its mineral resource base. The company has announced a restart plan for Jerritt Canyon, with production expected to commence in the second half of 2027. This plan is supported by an expanded mineral resource estimate. As of December 31, 2025, Jerritt Canyon hosts 4.1 million ounces of gold in the measured and indicated category, a 116% increase, and 3.7 million ounces in the inferred category. The Jerritt Canyon roasting circuit is one of only 3 in Nevada capable of processing refractory gold ores, making it a strategic infrastructure asset in one of the world's top mining jurisdictions. By pivoting to owner-operated mining and exploring bulk tonnage open-pit opportunities, First Majestic aims to generate meaningful shareholder value from Jerritt Canyon that was not previously reflected in its valuation.
Innovation and vertical integration, First Mint LLC. One of the most innovative aspects of First Majestic's business model is its wholly owned silver minting facility, First Mint LLC. This facility allows the company to vertically integrate the minting process, selling 0.999 plus fine silver rounds, bars, and coins directly to retail consumers. The financial impact of First Mint has been significant. In 2025, the facility generated record annual revenues of $49.4 million and operating earnings of $24.1 million. By bypassing traditional smelters and bullion dealers, First Majestic captures the retail premium that typically ranges from 5 to 25% over the spot price. In the fourth quarter of 2025, the average realized silver price for First Majestic was $69.74 per ounce, a 26% premium to the COMEX average. This direct-to-consumer channel serves as a natural hedge against spot price volatility. During periods of physical silver shortages, retail premiums tend to spike, allowing First Majestic to maintain high profitability even if wholesale paper markets are constrained. The company is currently expanding First Mint's capacity to process a larger percentage of its Mexican production, further enhancing its margin profile.
Financial strength and capital allocation. First Majestic enters 2026 with the strongest balance sheet in its history. The company capitalized on favorable market conditions in late 2025 to refinance its debt and accumulate a substantial cash reserve. Liquidity and debt management. As of the end of 2025, the company held approximately $938 to $940 million in cash and equivalents, with a working capital position of $733 million. This liquidity provides a massive war chest for strategic opportunities, including further M&A or the internal funding of expansion projects like Jerritt Canyon and the Santa Elena mill upgrade. In December 2025, First Majestic completed a $350 million offering of 0.125% unsecured convertible senior notes due in 2031. This offering was used to repurchase approximately $174.7 million of existing 0.375% notes due in 2027, effectively pushing out maturities while securing a best-in-class coupon rate. The conversion price of $22.36 per share represents a significant premium to recent trading levels, reflecting management's confidence in the company's long-term upside.
Enhanced dividend policy. Reflecting its commitment to returning capital to shareholders, the board of directors doubled the company's quarterly dividend target in early 2026. The new policy targets a dividend of 2% of net quarterly revenues, creating a direct link between silver price appreciation and shareholder yield. This transparency is rare in the mining sector and is designed to attract a broader base of income-oriented institutional investors. Resource base and long-term value creation. The 2025 Mineral Reserve and Mineral Resource Update demonstrates that First Majestic has not only replaced the record depletion from its 2025 production, but has significantly expanded its asset base to unprecedented levels. The company's focus on the drill bit as a primary tool for value creation resulted in a 50% year-over-year increase in measured and indicated M&I resources and a 69% increase in inferred resources on a silver equivalent basis. The growth in Aggie quick ounces was driven by a combination of exploration success and updated metal price assumptions. At a silver price of $80 plus and a gold price near $3,000, previously marginal mineralization becomes highly economic, allowing for the reclassification of substantial tonnages into the resource base. Santa Elena and Jerritt Canyon were the primary drivers of this growth, reinforcing their status as the long-term engines of the company's valuation. Valuation and comparative multiples. First Majestic currently trades at a valuation that many analysts consider fairly valued based on historical metrics, but significantly undervalued when considering its growth potential and silver leverage. In a silver bull market, producers typically experience a multiple expansion as investors pay a premium for liquid, pure-play exposure. While Pan American Silver is larger by market capitalization, it is significantly more diversified into gold and base metals, reducing its sensitivity to the silver price. First Majestic remains the purest play for investors seeking silver torque. Bull market targets suggest that if silver reaches $150 per ounce, First Majestic's operating cash flow could surge to $2.1 billion, supporting a target price between $60 and $80 per share, based on historical bull market multiples of 18x to 20x PCF.
A comprehensive bear case analysis for First Majestic Silver, structural fragility, and the valuation disconnect. The equity market's recent enthusiasm for First Majestic Silver has been largely predicated on a confluence of record-high silver prices and the transformative acquisition of Gatos Silver.
However, an analysis of the company's underlying cost structure, the escalating jurisdictional risks in Mexico, and a high-risk capital allocation strategy in Nevada suggests that the current valuation is decoupled from operational reality. While the 2025 financial turnaround appears robust on the surface, with revenue doubling to $1.26 billion and a return to nominal profitability, these results are heavily buoyed by a silver mania price environment that masks profound structural inefficiencies.
The bear case for First Majestic is rooted in the unsustainable nature of its all-in sustaining costs, AISC, which are projected to spike into the $26 to $28 per ounce range in 2026, leaving the company with virtually no margin of safety if commodity prices normalize. Furthermore, the company faces a multi-front legal and regulatory crisis in Mexico, including a finalized $155 million tax liability for a single fiscal year and a broader legislative reform that fundamentally erodes the long-term value of its primary assets. When combined with a history of aggressive equity dilution and a speculative $75 million restart gamble at the Jerritt Canyon gold mine, an asset that has failed twice in recent history, the risk-adjusted outlook for First Majestic common shares is decidedly negative. The mirage of profitability, financial performance, and cost escalation. First Majestic's 2025 fiscal results represent a dramatic pivot from the losses incurred in 2024, yet they also reveal the company's extreme sensitivity to spot prices. Revenue reached $1,257 million in 2025, driven by a 47% increase in realized silver prices to $41.52 per ounce.
While net earnings of $210,970,000 mark a significant recovery from the $101,880,000 loss in the prior year, a substantial portion of this gain is attributable to the consolidation of Gatos Silver and a $126.8 million fair value gain on marketable securities recorded in other comprehensive income. When these non-operating items and the benefit of a peak price environment are stripped away, the core mining operations remain among the highest cost in the industry. The central pillar of the bearish operational thesis is the alarming trend in AISC. In 2025, the consolidated AISC was reported at $21.17 per silver equivalent, or AGEQ ounce. However, the 2026 guidance anticipates a massive escalation to between $26.15 and $27.91 per AGEQ ounce. This cost profile is unsustainable in anything other than a record-breaking silver market. For context, historical silver prices have frequently traded below $20 for extended periods. If silver were to retrace even to $25, First Majestic's entire 2026 production would likely generate negative free cash flow on an all-in basis. This cost structure places First Majestic at the very top of the global silver cost curve, making it the most vulnerable producer to any price correction.
The 2026 cost increase is primarily driven by lower metal grades, resulting from a reduced cutoff grade. While management frames this as a margin over volume strategy designed to maximize the extraction of the resource base during high price cycles, it effectively increases the cash burn risk. By lowering the cutoff grade, the company is processing more waste and low-grade material, which increases the energy, labor, and chemical costs per ounce of finished product. In an inflationary environment where the Mexican peso has demonstrated volatility and labor costs in the mining sector are rising, this strategy leaves the company with a dangerously thin margin of safety. The Mexican tax crisis, a finalized and expanding liability. The most immediate and quantifiable threat to First Majestic's balance sheet is the ongoing and intensifying conflict with the Mexican tax authorities, the Servicio de Administración Tributaria. For over a decade, this dispute has centered on Primero Empresa Minera, a subsidiary that operates the San Dimas mine. The SOT nullified a 2012 advanced pricing agreement that allowed the company to pay taxes based on realized prices under a streaming agreement rather than higher market spot prices.
In late 2025, the legal battle reached a catastrophic turning point. The Mexican Supreme Court unanimously upheld a tax ruling that obliges PEM to pay approximately 2.87 billion pesos, equivalent to roughly $155 million, for the 2012 fiscal year alone. This ruling overturned a previous procedural win for the company and effectively exhausted domestic appeals for that specific year. The $155 million includes the base tax, surcharges, updates, and fines. This liability represents a direct hit to the company's cash reserves and is merely the tip of the iceberg. The SAT has already finalized reassessments for the years 2010 through 2017 using the same methodology.
Management has previously estimated that the total incremental income tax for the 2010-2019 period could reach $314.2 million before interest and penalties. However, with interest rates and inflation adjustments factored in over a decade-long dispute, the total exposure likely exceeds $500 million. The Supreme Court's refusal to hear further appeals on the 2012 reassessment sets a devastating precedent for the remaining years. This creates a liquidity trap where the company may be forced to choose between paying massive tax bills or facing the continued freezing of its Mexican bank accounts, a measure the SAT has already implemented at Banamex and Banorte.
Furthermore, the Mexican government's stance has become increasingly aggressive. The SCJN recently imposed a fine on PEM for what it described as unfounded motions intended to delay the proceedings, signaling that the judicial system has lost patience with the company's defensive tactics. While First Majestic continues to pursue NAFTA ICSD arbitration, international tribunals rarely interfere with a sovereign state's right to collect taxes, especially when domestic courts have issued a final ruling. The company's request for provisional measures to unfreeze its accounts was recently contested by the Mexican state, which argued that the taxpayer must provide customary guarantees before any relief is granted. This ongoing legal siege creates a permanent overhang on the stock and a significant risk to its $793 million cash position. Jurisdictional risk, the 2023 to 2025 mining law overhaul. First Majestic's operational concentration in Mexico, accounting for 96% of its 2025 sales, makes it uniquely vulnerable to the most radical mining law reforms in the country's modern history. The 2023 federal mining law reform, which has been upheld by the Supreme Court in late 2025, fundamentally alters the economic landscape for Canadian miners.
The reforms introduce several setbacks for long-term valuation. 1. Concession duration. The reduction of concession terms from 50 to 30 years, with renewals subject to public bidding, removes the perpetual nature of mining assets. For long-life mines like San Dimas or Santa Elena, this introduces a terminal value risk that is not yet factored into DCF models. 2. Profit sharing, PTU. A new legal mandate requires companies to pay at least 5% of mining profits directly to affected communities. This is an additional layer of social royalty that sits on top of existing taxes and the standard 8.5% EBITDA royalty. 3. Water scarcity and priority. The new national water law prioritizes human consumption and gives the state the power to revoke water concessions for mining if local supplies are deemed insufficient. Given that First Majestic operates in arid regions of Durango, Sonora, and Zacatecas, the risk of operational shutdowns due to water politics is a primary concern. 4. Open-pit ban sentiment. While the Sheinbaum administration has tempered the absolute ban on open-pit mining to allow for aggregate extraction, the moratorium on new mining concessions remains in place. This effectively limits First Majestic to its existing licensed areas, stifling long-term organic growth.
The impact of these laws is already being felt. In February 2026, the Mexican government recovered more than 1,200 concessions due to non-compliance with new apporting obligations. While First Majestic's core operating mines are currently permitted, the permit moat comes at the cost of significantly higher administrative and environmental compliance spending, further bloating the AISC. Jerritt Canyon, a $75 million speculative gamble. In April 2026, First Majestic announced a $75 million restart plan for its Jerritt Canyon gold mine in Nevada, targeting a return to production in the second half of 2027. To the bull case, this represents geographic diversification into a Tier 1 jurisdiction. To the bear case, it represents a high-risk capital sinkhole in an asset that has a proven track record of failure under the company's management. Jerritt Canyon was purchased in April 2021 and was placed on care and maintenance less than 2 years later, in March 2023. The suspension was blamed on high contractor costs, inflationary pressures, and extreme weather. Now, the company plans to reinvest $75 million into the same asset without the benefit of a completed pre-feasibility study or feasibility study that demonstrates economic viability. The PFS, being conducted by Stantec, is not even due until the end of 2026. Committing significant capital to mine development and equipment procurement before the technical and economic studies are finalized is a breach of conservative mining practices and increases the technical risk of failure.
The resource versus reserve trap at Jerritt Canyon. The company has highlighted a massive increase in mineral resources at Jerritt Canyon, reporting 4.1 million ounces of gold in the measured and indicated M&I categories. However, a resource is not a reserve. Management has explicitly cautioned that measured and indicated mineral resources do not have demonstrated economic viability. The shift toward a hybrid mining model, targeting both underground and bulk tonnage open-pit opportunities, introduces a new set of permitting risks in Nevada. Transitioning to open-pit mining often requires multi-year environmental impact statements and can be met with significant regulatory pushback, particularly regarding dewatering and tailings management. Given the mine's history of underperformance, there is a distinct possibility that the $75 million investment will not yield the expected returns, leading to future impairments that would erode the equity base. Portfolio decay and the Gatos integration. While the acquisition of Gatos Silver was transformative, adding 12.7 million AGEQ ounces of annual production, it also highlights the deteriorating quality of First Majestic's legacy assets.
San Dimas, the maturing flagship. San Dimas is increasingly challenged by its age and geological complexity. While it remains a significant producer, the 2026 guidance shows a reliance on deep-seated vein systems like Coronado, which require extensive and expensive drilling. The mine's ability to maintain high silver grades is weakening, and the reliance on gold as a primary byproduct credit makes its silver AISC highly sensitive to any correction in the gold price. Santa Elena, the inferred confidence gap. The exploration success at Santa Elena, specifically the Santo Niño discovery, has been used to justify the stock's premium valuation. Santo Niño added 27.4 million AG-equal ounces to the company's resource base. However, 100% of these ounces are in the inferred category. Inferred resources have the lowest level of geological confidence and cannot be used for economic mine planning. The market is currently pricing in these ounces as if they are ready for extraction, ignoring the multi-year process and tens of millions of dollars in capital required to convert them to indicated and then to probable reserves.
Los Gatos, the non-controlling interest drain. The inclusion of Los Gatos has significantly boosted consolidated net income, contributing $151.5 million in 2025. However, First Majestic only holds a 70% interest in the joint venture. This created a new non-controlling interest, NCI, on the balance sheet of $411.9 million. When investors look at the consolidated net earnings of $211 million, they often overlook that a substantial portion belongs to the NCI, not First Majestic common shareholders. On an attributable basis, the earnings power is significantly lower than the headline consolidated figures suggest. The dilution engine and capital structure. A central pillar of the bear case is First Majestic's track record of shareholder-unfriendly capital management. The company has used equity as a perpetual funding source, leading to a massive expansion of the share count that has outpaced production growth.
Share count and EPS erosion. In 2025, First Majestic's shares outstanding spiked to 485 million, a 64% increase year over year. This was primarily driven by the Gatos acquisition and the issuance of new convertible notes. While the company returned to profitability in 2025 with an EPS of 34 cents, this figure is a far cry from the $1 plus EPS figures seen in previous high-price cycles when the share count was below 250 million. The earnings power per share is being structurally diluted. The company's PE ratio, currently sitting at 64.9 times TTM, is an anomaly in the mining sector. Competitors like Pan American Silver, PAAS, trade at 21.3 times earnings. The market is currently valuing First Majestic as a high-growth tech stock rather than a mature, high-cost commodity producer. This valuation premium is highly fragile and could collapse if the company misses production targets or if the silver price plateaus.
The debt cycle. Convertible notes due 2031. In early 2026, First Majestic completed a $350 million offering of 0.125% unsecured convertible senior notes due in 2031. While the interest rate is nominal, the conversion price of $22.36 represents a potential ceiling for the stock and a source of future dilution. The proceeds were used to repurchase $174.7 million of the 0.375% notes due in 2027. This strategy of constantly rolling over debt into new convertible instruments manages liquidity but ensures that the share count will continue to rise in any scenario where the stock price performs well. Insider behavior, following the money. A telling indicator of management's view on the current valuation is the flurry of insider selling in early 2026. While the stock was rallying toward its 52-week highs, several key executives and directors offloaded significant positions. In February 2026, CEO Keith Neumeyer sold several blocks of shares, including 52,500 shares at $25.70 and 17,500 shares at $23.94. Other high-ranking officers, such as Amar Parmar, Director of International Taxation, and Mani Al-Kafaji, President, also engaged in substantial selling throughout February and March 2026.
Comparative analysis. When evaluated against its peers, First Majestic consistently ranks as the most expensive and highest risk option in the silver space. Hecla Mining. Hecla operates primarily in the US and Canada, avoiding the jurisdictional nightmare of Mexico. Its AISC of $11.01 in Q3 2025 is nearly half that of First Majestic. Hecla's Lucky Friday and Greens Creek assets are world-class, low-cost mines that provide a much more stable foundation for cash flow. Pan American Silver. PAAS has a much more diversified geographic footprint, North and South America, and a significantly larger market cap of $23 billion, providing greater liquidity and institutional stability. PAAS trades at a PE of 21.3x compared to First Majestic's 64.9x, while maintaining a higher net profit margin of 27%.
Endeavor Silver. While Endeavor also operates in Mexico, it is in the process of commissioning the Terronera mine, which is expected to be a low-cost, high-margin asset. Endeavor's AISC projections, while rising, are more competitive when byproduct credits are factored in, and its valuation is significantly lower on a price-to-NAV basis. Silvercorp Metals. Silvercorp maintains some of the lowest AISC in the industry, $9.82 in fiscal 2025, and has a massive cash pile of over $360 million with minimal debt. The comparative data reveals that First Majestic is an outlier. It carries the highest operational costs, the most significant legal liabilities, and the most expensive valuation multiple in the sector. Investors who are bullish on silver have multiple alternatives that offer better protection against price volatility and lower structural risk.
The margin over volume delusion. Management's justification for the 2026 cost spike, the margin over volume approach, is a strategic gamble that relies on the greater fool theory of commodity pricing. By lowering cutoff grades to capture lower-grade mineralization, the company is effectively betting that silver will stay above $70 or $80 for the long term. If this thesis fails, the company will be stuck with a high-cost operational footprint that cannot be easily scaled back. The move from 21 to 27 AISC in a single year represents an abandonment of cost discipline. It suggests that First Majestic is no longer a mining company focused on efficient extraction, but rather a high-torque silver exposure vehicle. For professional investors, this torque works both ways. The downside leverage of a 27 AISC is extreme. Every $1 drop in the silver price below $30 hits First Majestic's bottom line significantly harder than it hits Hecla or Pan American.
Conclusion. The bull case rests on the fact that First Majestic Silver has emerged from a transformational 2025 fiscal year as a leaner, more profitable, and strategically superior silver mining entity. The acquisition and integration of Cerro Los Gatos provided the high-margin foundation necessary to thrive in a volatile market, while the margin over volume pivot ensures that the company is maximizing shareholder value during the current silver supercycle. The company's unique vertical integration through First Mint, its massive $938 million cash position, and its record-high resource base of 652.8 million AGEQ ounces in the M&I category provide a safety margin and growth runway that are unparalleled among its primary silver peers. As industrial demand from the green energy and AI sectors continues to outstrip mined supply, First Majestic stands as a vehicle for investors seeking high-torque, strategic exposure to the world's most important industrial precious metal. The transition from a volume-focused miner to a high-yield profitability engine marks the beginning of what analysts term the era of supermargins, positioning First Majestic for substantial valuation appreciation.
The bear case for First Majestic Silver is encompassing financial, operational, legal, and regulatory dimensions. The company's current market capitalization of over $10 billion is built on a foundation of peak commodity pricing and speculative growth. 1. Financial vulnerability.
An AISC of $26 to $28 is a danger zone that leaves no room for operational errors or price retracements. The 2025 profit was a product of a temporary price spike and non-operating fair value gains. 2. Tax and legal siege. The finalized $155 million liability for 2012 is a harbinger of a $500 million plus total tax drain. The freezing of bank accounts by the SAT proves that this is a critical liquidity threat, not just a theoretical accounting risk. 3. Jurisdictional deterioration. The 2023 Mexico mining law reforms have permanently lowered the value of the Mexican portfolio by shortening concession terms and adding new profit sharing and water rights constraints. 4. The Jerritt Canyon sinkhole. Reinvesting $75 million into a failed mine without a feasibility study is a capital allocation red flag that could lead to significant future write-downs. 5. Valuation paranoia. Trading at 64.9x earnings and ultra-expensive value scores, while insiders are selling shares at 52-week highs, indicates that the smart money is exiting the position. The data indicates that First Majestic has become a speculative paper silver play disguised as a miner. The underlying business is struggling with grade decay, uncompetitive costs, and a hostile sovereign environment. As the silver mania cooldown inevitably occurs, the structural flaws detailed in this report will likely lead to a significant downward re-rating of the shares to align with the more rational valuations of its peer group.